All right, everybody, thanks for joining today. My name is Trevor Gravink, and what we're going to talk about today is reverse 1031 exchange strategy. I work with a lot of investors and market for DSCR loans, and so I've ran into a lot of investors recently that perhaps would think about doing a 1031 exchange, but with the market the way it is, it's a little bit risky for them to be able to have to sell and find a property all at the same time. So this is a tool that you can be able to help them with this 1031 reverse exchange. So first of all, if you don't or are not familiar with what a 1031 exchange is, it's just a tax break so you can sell a property held for business or investment purposes and swap it for a new one that you purchase for the same purpose, allowing you to defer the capital gains tax on the sale. Okay, so what I'm talking about with the timelines is you have 45 days of the sale of your property with a normal 1031 exchange to be able to designate the replacement property in writing to the intermediary, specifying the property that you want to acquire. And then you have a total of 180 days to be able to then close on the new property. So just so everybody is aware, it's a total of 180 days. So if you use the 45 days, you'll just have 135 days left to close on the new property. Obviously, that's not very much time given in the market where it is right now, how competitive it can be with such low inventory. So a lot of investors are not doing 1031 exchanges because of the fact that they have this risk. And so that's why today I wanted to invite Brian from Lensure on. They have a great reverse 1031 product along with another bridge product that he can talk about for normal home buyers as well. So Brian, thank you for joining us today. And I'm going to go ahead and allow you to kind of take it over from here. And before we get in, just Lensure's reverse 1031 exchange. It's a win for you and your clients. It's going to allow them to buy new properties and continue collecting rent and sell at the best price, free of immediate tax burdens. So Brian, thank you for coming with us, and maybe you can get into kind of the current market conditions and why this is a good product for loan officers and for realtors to talk about with investors.
Absolutely. Trevor, thanks for having me. I appreciate it. Hello and welcome, everyone. We are a non-QM lender that does a lot of different things, but this particular program we're going to be talking to you about today, the Reverse 1031 Exchange Bridge, to our knowledge, we are the only company in America, other than a small bank in Texas, that does a limited number of these for Texas properties only. We're the only other company in America that offers this particular program. I actually showed this presentation to a gentleman that owns a 1031 exchange company last week, and he was blown away that this product now exists. So it gives you guys a chance to capitalize on something that no one has. So let's talk current market conditions. As you all know, I'm not telling you anything you don't know here, but inventory continues to stay very limited. Average multiple offers on a house, typically week one of listing it, as long as they're priced right, of course. Historic amount of equity tied up in residences, and homeowners are locked into historically low fixed rate loans in the 2s and 3s. So, Trevor, do you want me just to tell you to go to the next slide, or as we go through this?
Are you not seeing the cash out refi slide?
No, now I am. Yeah, it was stuck on mine. Okay. All right. So we offer a two loan solution, and I'm going to start with our traditional bridge loan so that you can understand what it is that we do from a bridge standpoint, and then we'll specifically jump into the reverse 1031 exchange. So it's a two loan process. First of all, we do a cash out refinance on the current property. We'll go up to 75 LTV on up to $1.5 million, and we'll do 65 LTV up to 3 million. Our rate sheet says 2 million, but we go as high as 3. Interest rate is now 9.5, and that's on all LTVs. It is a 12-month interest-only loan with no payments. It's a balloon payment due either in 12 months or when the property sells. Most of these loans pay off within 2 to 3 months in this market. Some of them pay off in a month. Again, there's no payment during the term of the loan. There is an origination fee of 2 to 2.25 points. The 2% is up to 70 LTV. If you go to 75 LTV, it's 2.25. These are owner occupied and subject to TRID guidelines, meaning when we send out a CD on the cash out refi, you're going to need to allot yourself 7 days before we fund. So we want to make sure that we're backing into this the number of, just make sure our conditions get signed off by the underwriter. So when that CD goes out, the clock starts ticking. We've got 3 days before we can go to docs. And then we've got 3 days after they sign docs, right, a rescission. So loans pay off any existing liens. And then the balance would be used as the down payment. So it can be closed within 1 week of receiving the appraisal if pre-approved. So we can close fairly quickly, but the process will take 7 days from that first CD. So loan number 2, okay, so now we've pulled cash out of their existing home. We've paid off their debt, and anything left over is going towards the down payment on this loan. This is a purchase money loan. We can do standard full doc bank statement. And by the way, our bank statements can be pretty aggressive because we don't have a 50% expense factor. So we'll go as low as 10% based on a self-employed questionnaire that the borrower fills out with your help. We can do asset qualifier. We can do asset depletion. We can, any of the normal ways we do loans, we can do that in this particular case. So the beauty is our loan number 1, which is the cash out refi, has no impact on the DTI of this loan. So think about that for a minute. Not only does this loan is not affected by our bridge, but we pay off any debt they have. So that debt is no longer calculated into this DTI of this loan either. So in most cases, when you do a bridge loan, A, you have a payment, and B, they still have a mortgage payment. So you've got a DTI bust in most cases. That is what's beautiful about our 2-loan system, where we do the cash out refi, pay off the debt, no payments for 12 months, therefore no impact to the DTI on this loan. We have an 8-month EPO. So to avoid a chargeback, they need to make 8 payments on this loan. There's no prepayment penalty because it's owner occupied, but there is a chargeback if they don't make 8 payments. So we have an interest only loan option that's available that allows for recasting. So it's a 5-year interest only, 25-year fixed, 30-year loan. And if you think they have the wherewithal when they sell their property, they have enough equity to pay this loan down or off, we want to be putting them into this interest only program because it's the only one we have that will recast. So if they could pay 90% of that off when they sell their home, this loan, and as long as they keep at least 10% on there and make a total of 8 payments, we're good. So if they sell in 2 months, they make the first 2 full monthly payments, and then they could pay 90% of it down and make a 10% of that payment for the next 6 months for a total of 8. That's how we avoid an EPO. Point stacking is available, and that is one of our claims to fame. We allow the borrower to finance your broker compensation and rate buy downs. So if they're rate sensitive on this loan, we can buy the rate down up to a whole point or the floor, whichever's lower. And then the compensation and the buy down can both be financed. Typically, it's a 2 or 3 to 1 to buy the rate down, and then your broker comp, of course, just can be financed as well. The lower the LTV, the more we can finance. So we can typically close concurrently with the first loan. Not always. if they're in different states, we'll have to close the cash out on one day and we'll close this purchase money loan on the following day. But if they're in the same state, especially here in California, we typically close and fund both loans concurrently. And these are fully underwritten pre-approvals that allow for a peace of mind when with certainty that you're going to close. The big thing here is that when we have a file that comes over to us, just understand we don't have a DU process. We have a credit analyst that's actually reviewing the file, and they're a junior underwriter. So when it gets pre-qualified, it'll close. I've been here over 4 years, and I'm knocking on wood, but I've never had one file that we've done a pre-qual that we were not able to close. So that's exciting to know. All right, so here's an example of the bridge loan scenario. Let's say you got a home worth $1 million, and the LTV that we want to go to is 75, and they have a $250,000 mortgage. So they've got $750,000 in equity. So what we'll do is we will loan the up to $750,000. We pay off the $250,000, so that leaves $500,000. They have, in this scenario, they have an extra $250,000 in liquid assets. So basically, they would put that with our $500,000 left over from the $750,000 bridge loan, leaving $750,000. So loan number one would be $750,000. We pay off the $250,000, leaving $500,000 to go to loan number two. Loan number two would also be $750,000, and with the $500,000 and the $750,000 both coming in. So two loans, we take care of both properties. There's no impact from the $750,000 cash out because there's no payment. That $250,000 mortgage goes away, and all you have to worry about is the $750,000 purchase money loan to DTI. Okay, so the big benefits to the borrowers, they can go out and make non-contingent offers. So in this market, we all know that no one's accepting contingent offers. Well, I shouldn't say no one. I had the first contingent offer accepted that I have seen in the last 2 years, just about 2 weeks ago. But on the whole, that is not common. People just aren't accepting contingent offers. So this allows them to go non-contingent with confidence. It allows the borrowers to sell their home without being under duress or in a weak negotiating position. And it allows the borrowers to shop without accruing interest because we don't do the bridge loan without funding the purchase money loan. So nothing starts until they find that home, and we're in escrow and we close. So the huge motivating factor here, of course, is their dream home. And the DTI is typically restricting them from carrying two loans simultaneously. That's why I've spent a little bit of time talking about how we take care of that issue. A lot of times people have a significant amount of their net worth tied up in their property. And if they have enough equity to pay cash for the replacement property, this is not a program for them. So I want to repeat that again. If you've got someone that has a $3 million home, owns it free and clear, they're probably not a good candidate for this program because they don't need it. We're looking for the people that typically have DTI issues. And of course, the big benefits to the real estate agents is it allows them to re-engage with their potential clients. Sales volume year over year is down, so it can help them. And it allows them the opportunity to get both the buy and sell side with the clients because a lot of times these listings, people aren't even looking because the agents and the sellers are not aware that this program exists. So I've had a couple LOs who have just been calling listings with success, I might add. Okay, so bridge loan private label resource kit. I will send a link to Trevor when we're done that he can disseminate that will have this particular resource kit in it, with a lot of other support materials as well. But these are private label flyers. All you need to do is upload them to your computer before they are editable. That's the biggest advice I have on that page. Okay, so that is our bridge. And now that you understand it's a two-loan process, we take care of the DTI issues. Now we can start thinking of this from the investment standpoint. So let's kind of go through this. So deferring the capital gains on a 1031. Who are we looking for? Typically, these are seasoned, savvy investors, typically with high credit scores, and their most common thing is they don't want to liquidate stocks or bonds or have to sell another piece of property or have to sell their existing property before they buy a new one. And pricing is not a big issue to them because of the substantial capital gains tax savings that you're going to see here in a minute. So let's run through a simplified example of how to calculate capital gains. So James purchased an investment property for $200,000 in 2002. He spent $15,000 on improvements. He sold the property for $800,000 in 2023. So his capital gains would be $585, which is the selling price minus the purchase price plus improvements. So on that $585, the federal long-term capital gains tax would be $117,000 at 20%. And the California capital gains tax at 13.3 would be $77,805. So we're talking close to $200,000 for capital gains tax in this scenario. So a 1031 exchange in action. The investor owns several investment properties, including a house in Murrieta, and he purchased that 15 years ago for $188,000. He's been renting the property to long-term tenants. He put about $65,000 in improvements, so that brings his cost basis to $253. Purchase price plus improvements. The house needs a new roof, 30 grand. He doesn't want to spend it. So instead, he wants to get a new property that doesn't require investment improvements. So the property is now worth $600,000. So it has appreciated by $347,000 over the cost basis, putting him in a position where he'll have to pay some pretty big capital gains. If you look over to the right, you're talking about a total of $93,690 in capital gains in this particular scenario. So a reverse 1031 exchange lets the investor buy the replacement property first while still deferring the capital gains taxes on the subsequent sale of their original investment property, which we call the relinquishing property. So it's a great option when an investor finds an ideal replacement property that they don't want to miss out on, but they haven't sold their original property. So the process is, I'm going to go through this one a little slower because this gets a little complicated. The investor engages a QI who will facilitate the exchange transaction. And that is a qualified intermediary. The qualified intermediary will guide them through the process and make sure they're IRS compliant. The QI provides an EAT, which is an exchange accommodation title holder. Typically, that's an LLC that will temporarily hold the title to the replacement property on the investor's behalf until the entire process is completed and he sells that relinquishing property. The reason for that is the IRS will not allow the investor to be on title during this process, or they forfeit their exchange, their 1031 status, the tax deferred status, which is, as you can see, huge, sometimes multiple six figures. So the with the EAT in place, the investor can proceed to acquire the replacement property. The transaction will be structured as if the EAT is the buyer because they are. So basically, look at it this way. The investor becomes the primary beneficiary of the LLC and remains 100% control of the property, but the EAT is actually the legal owner. So the investor identifies the relinquishing property to be sold within 45 days of the purchase of the replacement property. So they have up to 180 days following the purchase of the replacement property to sell that relinquished property. So in other words, an investor goes out, finds a hot deal, and wants to jump on it, but doesn't want to cash in stocks for a down payment, doesn't want to cash in bonds, doesn't want to liquidate something to be able to put down, and doesn't want to use his cash, wants to use the cash out of the property he's going to sell. That's where this comes in handy. So once the relinquished property is sold, the proceeds from the sale are transferred to the QI, who then completes the reverse exchange and transfers ownership from the EAT back to the investor. And the beautiful thing during this process is the investor still continues to collect rents while there's no payment on our bridge. So I think the next slide talks about this is an example. So let's go into a reverse exchange in action. So here's an investor that wants to buy a property in Lake Tahoe, a couple blocks from her residence, worth $1 million. She knows the home will sell quickly based on the selling price. Excuse me. She also owns an investment property in Bozeman, Montana, worth $930,000 that she owns free and clear. This is the one she intends to sell, but the sale will take place after the purchase of the Lake Tahoe. So she needs a reverse exchange. She wants tax treatment of a 1031, even though she hasn't sold the investment property she owns in Bozeman. So the goal is to not have to pay capital gains taxes at this time, which in this case, if you look over to the right, would be $117,450 because she bought that Bozeman home for $480, put 15 in. Her cost basis is $495, but it's now worth $930. She doesn't know anything. So the capital gains is $435,000. So for California, it'd be $30,450, and for federal, it'd be $87,000. So you can see that's a pretty big motivator to want to defer. So financing a reverse 1031 exchange using Lensure's bridge loan. This is what I thought the next slide was. So let's go back to the investor who wants to buy the investment property in Lake Tahoe for $1 million and wants to jump on the opportunity and close it in 2 weeks. So she needs time to list and sell her free and clear property in Bozeman, which is worth $930. And so she can use our bridge loan to access the capital from her Montana property for the down payment on the purchase loan in Lake Tahoe. These two loans will fund at the same time. And after the Lake Tahoe purchase transaction is closed, the borrower can then focus her attention on selling her Bozeman property. And the Bozeman property will need to be sold within 180 days of closing the Lake Tahoe purchase in order to satisfy the 1031 exchange requirements. So let's go through it on the right. Her home in Bozeman is worth $930. She doesn't know anything on it. So we'll do a loan to value of 60%. That's the max we can go on this program. So that is a loan amount of $558. Again, she doesn't know anything, so the proceeds will be $558, less cost. It'll be a little less than that. So property B is the home in Lake Tahoe. The purchase price is $1 million. Well, we're going to be putting down $558,000 from the bridge loan, and that leaves a loan amount of $442,000. We need to do both loans. We don't do any standalone bridges. I'm sure that is probably a common question I get, so I wanted to address it now. So the new loan to value is 44.2%. We would fund both loans concurrently, and we would do it through the help of a QI, qualified intermediary, or a safe harbor company. So it allows the investors to proceed with the acquisition of the replacement property without having to wait to sell their original property. So this is a buy before you sell. So investors can avoid missing out on potential replacement properties that may not be available for long. They can continue to collect rents on the original property while not making any loan payments, as I mentioned. And it gives the investors time to do improvements on their original property, in this case in Bozeman, so she can get the best possible price for her Bozeman property.
Thanks, Brian. So I do have a couple different questions for you. As far as the guidelines and some of the conditions and things, Brian, in those other slides, what I'm going to do is share some links with you guys if you have specific wanting to know like what the borrower needs to bring for this type of loan, rather than getting into kind of the weeds of conditions and packaging a file and those things. We'll just supply that information to you and where you can get that. And so a couple different questions just to make sure that everybody's familiar with it. Brian, what is the minimum credit score needed to qualify for the reverse bridge and just your standard bridge?
So both of them, the rate sheet says 680, but I've done loans for the bridge loan at less than 680. So I'm going to say 60% of our loans have exceptions. We're a common sense lender. If we like the rest of the file makes sense, and they've got, uh, you know, lower credit score. Maybe we had one a couple months ago that none of us could understand why the score was so low. It just didn't make any sense to us because looked like great credit does. So we pretty much ignored the score. So it will depend on the totality of the file, but the main answer is 680. But send it to me if you've got questions. If it's less.
All right. And can you get into, again, I know you went over it, but just the maximum LTV on the normal bridge and then on a reverse?
So it's 75 LTV max on the normal and 60 LTV on the bridge, or on the reverse exchange bridge.
Okay. And just to be clear, since it's two different loans, there would be two different underwriting fees and two different appraisal fees, correct?
That is correct. 1595 for full doc, 1895 for bank statements, and each loan would have its own underwriting fees. That is correct.
Okay. And for
And let me just take a second there, Trevor, because the one thing our slides did not cover was compensation on the bridge. This comes up frequently. Understand that the bridge loan was created as a means to get the purchase money loan. If you think about it, in most cases, you wouldn't be able to do a purchase money loan because the bridge loan payment and their existing mortgage payment would typically nullify their ability to qualify. So what we did is create this program so that the bridge is more of a means to an end. It's a means to get the purchase money loan. So the compensation on the bridge, we charge either 2% or 2.25%. And depending on the loan size, if you've got a $500,000 at least loan size, we could typically pay a half a point on that one to you for compensation. And if it's $1 million loan, we can typically pay a point. And the reason we can't pay more is we hit a Section 32 high cost threshold. And I won't know what that is until we want to run the file through our model, our high cost threshold model. So, but that's a general rule of thumb. I can get you a 1/4 point if the loan is at least 300,000. If it's less than 300,000 on the bridge, and our minimum loan amount for the bridge is 250. And on that, sometimes there's not enough room to pay anything, but you can charge full commission on the purchase money loan, which is what this whole program was designed to be able to do.
And then to be sure, you could do a DSCR loan on the purchase side, correct? For the
Yes.
next property? Okay.
Yep.
And then how long do they have to still meet the 1031 requirements to sell their current investment property? So they've closed, they found the property that they want, and then they've purchased the new investment property. They have how many days from that to be able to sell their current investment property?
180 days from closing.
Okay. And when do they have to start making payments on the loan for the reverse 1031 exchange?
So the reverse 1031 exchange bridge loan, there is no payments for 6 months. But the purchase money loan on both of these programs are your typical loans that are need to start being paid in like 45 days.
Okay, and I know you already reiterated this, so we all know that the debt to income ratio does not affect the new purchase. So that's obviously one of the highlights of this. And I can just speak upon what Brian said earlier about they're a common sense lender. I've had files over there before. Obviously, we all do with some non-QM lenders that don't meet exactly the box that's shown on the rate sheet or on their guidelines. And if it makes sense and we can make it work, Brian and his team has been great to be able to do that with plenty of loans for myself and my team. So Brian's information, just so you guys all have it here, if you want to write it down, is his contact info. If you're not set up with Lensure, make sure you reach out to him. He can always get you that broker package for yourself so you can get set up with him. And then the only question that I saw currently in the chat was something about payment shock, but that really wouldn't apply in this scenario, I don't think, because the new home would be getting the current equity from the current home, and especially on the reverse 1031 exchange, since they'd most likely be qualifying for a DSCR loan. So I don't believe there's any other questions in the chat, Brian, but anything else that everybody should know just about Lendsure, because I know you offer some other products as well, mostly in the non-QM space that other people could benefit from as well.
Absolutely. And I'll share a little regarding the payment shock. Um, the only time that we might have an issue with payment shock is on our primary to primary. And if somebody is trying to, go from a $250,000 home to a $2.5 million home, there might be an issue there. That's not common, but I wanted to at least address it. Where the most I've seen us go is 5 times payment shock. Our guidelines say 3, but again, it depends on the totality of the file. In any case, we don't want to set someone up for failure, nor do you. So, valid question. Let's go into like Trevor wanted to me to go over a couple of the things that maybe we're I don't want to say we're a typical non-QM lender because I don't think we are. I think we're a very forward leaning common sense non-QM lender. If the loan makes sense, we'll do it. And so a couple things that we do that are different than our competitors is again, on our bank statement loans, we don't have a preset 50% expense factor. We can go as low as 10. So if, let's say your client's a realtor working out of their home, we would probably hit them with a 10 or 15% expense factor. So a lot of times I can get more aggressive income on bank statements unless they own a restaurant. Restaurants are high operating expenses. We hit them with typically 80. So, that would be the exception. As far as DSCR goes, we do something that's very unique. Our DSCR, we allow qualification on the interest only payment, and we allow a rate buy down. So I've been able, because of these high rates, we've had to get creative to get the ratio to be a 1.0 or better. And by the way, we just came out with a no ratio DSCR. It literally adds 1 full point to the rate. However, we now at least have that option. I didn't have that a couple weeks ago, so I'm pretty excited about that. But getting back to my point, if you've got a 8.5% rate and it's just not DSCR ratioing because the interest rate's so high, Well, A, we can buy it down and finance that most of the time. It's a 2-to-1 or 3-to-1 buy down. At 8.5, it'd probably be a 2-to-1 buy down, meaning if we want to buy it down a point, it would cost two, and we could finance those. And then, so now we're in the sevens, and we could see if that was enough to get it to ratio, and then we can finance that as well. So plus we can use the interest only program. We now have a 5-year IO converting to a 25-year fixed, so that the payment would just be interest only. So between buying the rate down and an interest only payment, which is just calculating interest, taxes, insurance, and HOA if applicable, if it still doesn't DSCR, we can get to a lot more that do DSCR, but if it still doesn't, we now have the no ratio. So, which will add that point that we just bought down.
So,
But we'll be
so
able to
Brian,
do the deal.
yeah, so Brian, just to be clear that I understand it correctly, and hopefully it's a little bit more clear for everybody else. As far as financing the points, let's just say you are financing 2 points in to buy it down one, and we're talking about a $300,000 loan. So we're talking about $6,000 to be able to purchase it down. So the new loan would actually be 306,000 because you're financing that in, correct? That's how that would
That is
work.
correct. Thank you. I normally give a 500,000 with 2% example, but your 300 with the two is perfect. It becomes 306. So, and if it's not buy down, it's your compensation. Let's say you want to make 2 points on 500,000, the loan becomes 510,000, and we're financing your 2%, which is 10 grand.
Perfect.
So
Yeah, I don't know any of other lenders that offer that, and that's one of the reasons that I wanted to bring Lensure on, is because they do some creative things that I have not seen with any other lenders that I've worked with. So Brian, I really appreciate you jumping on today. Again,
Trevor, would
yep.
you mind if I just said one more program that just popped up in my mind?
Oh yeah, definitely. Go ahead.
I remember this just happened about 2 months ago. I had a situation where we had to use multiple incomes. We had W-2, we had 1099, we had K1, they were owners of several different businesses. We ended up using, like, I think it was 3 or 4 different bank statements that we ended up doing, and a combination of everything. And believe it or not, because it was a very high end property, they still didn't quite qualify. So we ended up combining it with asset qualifier and used the assets to get us to the income we needed to be able to DTI. So when I say we can get creative, I really mean we can get creative when you've got a tough situation with being able to DTI. So as long as it makes sense, obviously, the ability to repay does need to be there. But lastly, I had another case in point that, how many times do you guys get W-2 people who jump out to 1099 on their own? And they've only been doing it a month. I just had a guy that literally signed on with a new company. Had only been there 2 weeks, but he had been in the business for years doing the same thing, had a track record, and actually got a bunch of RSU stock that was not received yet, wasn't going to be received for 4 years. But because he had such a good track record in the industry, we were able to count the RSU income to be able to make the deal work. I don't know of any other lender that would do that. So we have, especially for professionals, doctors, attorneys, dentists, lawyers, if you got a situation like I just described and they don't have the 2 years, call me.
That's amazing, Brian. Well, thank you for sharing that, because that's definitely helpful. I've already got it in my notes here, so I know I got some unique situations every once in a while, so you'll definitely be hearing from me. But Brian, thank you very much for coming today and explaining the bridge and the reverse bridge to us. And for those of you that want to be able to get the marketing materials and also just the guidelines and everything, just go ahead and reach out to Brian or myself, and we'll get those to you. And if you have any additional questions, you have Brian's contact information. Thank you so much, Brian.
Thank you. I appreciate everyone's time.
Have a great day. Bye bye.
You too. Bye-bye.